You are likely bringing home a larger paycheck today than at any point in your career. Yet mathematically, you've never been closer to going broke. Earning promotions and climbing the corporate ladder used to guarantee long-term security. Today, it operates more like a treadmill. As your salary increases, your margin of safety actually shrinks, leaving high-earning professionals trapped on an escalator that leads nowhere. Instead, Americans increasingly view wealth as a psychological shield, the ability to buy your way out of the daily anxiety of survival and avoid the constant threat of insolvency. That anxiety has crept all the way to the top percentiles, creating a demographic known as Henrys, high earners, not rich yet. According to census data, roughly 14% of U.S. households generate over $200,000 annually, yet more than 60% of individuals with salaries exceeding $300,000 report actively struggling with credit card debt. Securing a top-tier income does not provide a sanctuary. The modern economic environment is highly optimized to seamlessly capture every additional dollar you earn. The pressure begins before the money even hits your bank account. Because the United States uses a progressive income tax system, a higher gross salary does not result in a linear increase in your take-home pay. Yet, the societal expectations placed on a six-figure professional demand that their lifestyle match their tax bracket, creating a dangerous gap between actual liquidity and visible consumption. To bridge that gap, consumers fall victim to an 18th-century behavioral glitch that functions as the engine of the modern economy, the Diderot Effect. In 1769, the French philosopher Denis Diderot received a luxurious scarlet dressing gown as a gift. It was beautiful, but it instantly made his old, modest belongings look incredibly shabby by comparison. To fix this aesthetic mismatch, Diderot began replacing everything he owned, his chair, his desk, his rugs, until he was deeply in debt, trapped by the standard of a single luxury item. Today, this psychological cascade targets the upwardly mobile professional. An annual raise allows you to finance a luxury car, but that car looks out of place parked in a modest apartment building, so you move to an upscale neighborhood. That new space demands premium furniture, and your new social circle expects higher-end dining and elevated vacations. The initial raise is completely absorbed. You have successfully upgraded your entire lifestyle constellation, but you remain tethered to the necessity of your next paycheck. You've simply built a more expensive cage on the exact same foundation of zero savings. The Diderot effect is most aggressively exploited by the American automotive market. Vehicles have transitioned from basic transportation utilities into massive, status-driven wealth destroyers. This bar chart breaks down Experian data from the end of 2025, detailing how we finance these assets. Across prime, non-prime, and subprime borrowers, loan terms are routinely stretched to 72 and often over 75 months just to mask the massive principal amounts. The result is an average monthly payment of $767 for a new vehicle. Financing a depreciating asset over 6 or 7 years guarantees a negative equity position. Worse, the interest rates applied to these extended terms act as a punitive tax on the financially fragile, scaling all the way up to 21.85% for deep subprime borrowers. Between payments and insurance, the average professional is locking away nearly $15,000 a year purely for transportation. While macro liabilities form the walls of the trap, digital microbleeds quietly drain the floor. The digitization of the American lifestyle has shifted consumer behavior from outright ownership to perpetual rentiership, with software, media, and now generative AI platforms demanding monthly revenue. Parallel to these digital subscriptions is the physical drain of outsourced dining. Bureau of Labor Statistics data shows the average household spends $4,567 annually on food away from home. For the high earner, delivery apps and restaurant meals are rarely perceived as luxuries. They become normalized as a baseline convenience required to sustain a high-stress career. Massive depreciating vehicle debt, combined with frictionless digital subscriptions and routine premium food deliveries, systematically shave the margins of every paycheck down to zero before a single dollar can be invested. This localized lifestyle inflation does not happen in a vacuum. It is deeply constrained by the macroeconomic policies established by the Federal Reserve. In 2020, the Federal Open Market Committee dropped the target rate to near zero. This environment of functionally free capital flooded the market, strongly incentivizing consumers to borrow heavily and aggressively inflate their lifestyles. This chart visualizes the immediate consequence. Aggressive monetary expansion unleashed intense inflationary pressures. The consumer price index spiked, and the cost of basic necessities, housing, gas, and groceries, surged far above the actual after-tax wage growth of the working public. To tame that inflation, the Federal Reserve executed a severe series of rate hikes throughout 2022 and 2023. Now, consumers attempting to roll over their credit balances or refinance their auto loans face a structurally higher cost of capital. The consumer who utilized zero. According to the Federal Reserve's annual survey, over a third of the adult population cannot seamlessly cover a basic $400 emergency expense without resorting to revolving debt or selling assets. Escaping this cycle requires a deliberate restructuring of behavior. First, you must explicitly sever the Diderot Effect. When you receive a salary bump, practice mindful shopping. Actively choose to retain your older, comfortable possessions rather than upgrading your entire lifestyle to match your new tax bracket. Second, introduce friction into your spending. Audit your bank statements. Pause dormant digital subscriptions. Third, reject massive auto market destruction. Refuse to finance depreciating vehicles and protect your monthly cash flow. Finally, recognize experiential dining for what it is. By reallocating just a fraction of the thousands spent annually on food away from home, you can rapidly build the liquid reserves required to easily absorb financial shocks. Income growth means absolutely nothing without proportionate savings growth. Until you actively defend your margins, the machine will keep you working infinitely harder just to afford the maintenance of your own captivity. Have you noticed lifestyle inflation creeping into your own budget? Let us know in the comments below, and be sure to like and subscribe to the MoneyWise Dollar channel for more financial breakdowns.